Hi, this is Mani from bsc2nse.com. So in this video, we are going to try to define some of the options trading basics, some of the terminologies, and this is for total newbies. And I'm not going to talk about options trading strategies, but I'm going to talk about options trading basics. What are the various types of options? What is the strike price in case of options? What is the premium? And what is the spot price? So to start off with, there are two types of options. One is the call option, wherein the buyer of the options contract expects or is betting that the markets will go up. The other is the put option, where the buyer of the contract is expecting the markets to go down. So I'm not going to talk about a seller of the contract. There are buyers and sellers as well. To start off, we'll just talk about the buyer perspective of the contract and what he looks to do, because most people or retail investors look to only buy options. We mostly do not look to sell options or write them. So in this video, I'm going to just talk about the buyer perspective. I'll make a separate video on selling options contract or what writing means. So as you see here, the call option I've marked in green because typically traders are going to expect the markets to go up. And a put option, as the name suggests, when we say put, it means you're dropping something or you expect the markets to drop or go down. So I've marked that in red here. So these are the two types of options. So basically, if I'm expecting the markets to go up, then we call it as call option. And when we expect the markets to go down, we will be looking to buy the put option. So that's marked in red here. The other thing you need to note is that options contract for every month will expire on the last Thursday of every month. For example, for this month, January, as you can see here, I'm just pulling up my calendar here. January 2014, the last Thursday is on 30th. As you can see here, I've selected 30th. So on 30th, all the January contracts will expire, meaning if the buyers were betting that the markets were going up and it doesn't go up, then whatever is the price that he needs to be settled back will be settled back. If the contract may also touch to zero, meaning you lose everything. So just to note that the last Thursday of every month is the expiry week, or the last Thursday is called as the expiry. So avoid trading during the week of expiry to be pretty smart, especially as a buyer. And terms to know, there are three critical terms to know. You need to know what is a strike price. Actually, strike price is nothing but the betting level. For example, I'm going to talk about Nifty in this video to be very specific, so that you get some clear idea of what I'm trying to say. So when I say Nifty 6400 call option, so let me put that up here. Nifty 6400 call option. So this is one particular contract, or let's say Jan 30th. So this is one contract, and I can say Nifty 6200 put Jan 30th. So when I say this, what does this mean? So this, like I said, is the call option. So I'm gonna like mark in green, and the put option I'm gonna mark in red because I'm expecting it to go down. So when I say 6400, actually the spot price is currently as on today, let's say Jan 16th. I'm making this on a weekend. So on Jan, spot price is nothing but the current actual traded price of Nifty, which is actually 6320 on Jan 16th. So there's actually, while I'm making this video, there's 14 more days to expiry. And premium is what we are going to pay, and what we trade on. So when we buy a premium at 100 and sell it at 120, it means that we'll be at a profit of 20 rupees. when we buy a premium at 100 and if we sell it off at 80, then we are at a loss of 20 rupees. So I'm gonna make some charts, show some charts to explain this. So when I'm saying Nifty 6400 call option, it means that I'm betting that markets will cross the 6400 level. So for this contract, the strike price is 6400, and for the Nifty put option like 6200 put, the strike price is 6200. So the premium will vary for each of these contracts. It will not be the same. And premium is what you trade on, what you pay, what you trade on. So this is the premium, what price you buy and what price you sell finally decides whether you make a profit out of the trade or whether you lose. So the spot price is nothing but the actual market price of Nifty, in this case, the index. So I'm gonna try and first explain to you um, a call option and what you will expect. Like you see in the graph, the last candlestick actually shows that the market is at 6320, where I've marked here the spot price as 6320. And today the date is 16 Jan, or the prices I'm using is as on 16 Jan. The expiry for the month of Jan is 30th Jan. So I've drawn values of 3 contracts on the right here. So the horizontal line I have marked, I have taken examples of 3 call option contracts this month and the actual values. So I'm marking a horizontal line straight to 6400, as you can see 6400 here. And I'm marking a horizontal line straight parallel to 6300 level. And I'm marking a horizontal line straight parallel to 6200. So as you can see, these are the strike prices. So 6200, 6300, 6400, this is called the strike price. And the 6200 call option I've marked this as green because everything is call option that I'm talking about in this chart. So the 6200 call option premium is currently 150 rupees. And the 6300 call option is currently at 80 rupees premium. The 6400 call option is at 35 rupees premium. So what this means, so when I say I am a buyer and I am expecting markets to go up, I can see that the trend is currently up. So I expect the markets to go up. So when I say I want to be a buyer of the 6200 contract, I'm buying at the premium of 150. It means that on top of 6200, I'm expecting 150 rupees on the upside. So 6350 I expect the markets to go, while the spot price is 6320 currently, which means I expect a further upside of 30 points in the next 12 days. And if tomorrow or on Monday when the market is opening up on the positive side, this premium will still further go up. And let's just say again, if I am a buyer, if I want to buy on the 6300 call option or the 6300 strike price contract, the premium is 80. Then I'm expecting the markets to touch 6380 by this expiry or in the next 12 days. And again, at the same time, 6400 contract is trading at 35 rupees. And as you keep going up, the premium is getting lower and lower, and that is understandable because you cannot expect the markets to touch higher levels, or if the premium is higher here, I would rather buy 6200 call. So I'm expecting the markets to go up above the strike price by this premium. So 6435 is the expected target. People who are buying this contract are expecting it to touch these levels. And so this is the case. So currently the spot price is 6320. Assuming by end of this month market stays at the same place, then the 6400 contract will end up being 0. And the 6300 contract will drop down to 20 rupees because it crosses 6300 by only 20 points at the end of the month. And the 6200 premium will drop from 150 rupees to 120 rupees. So the buyer of this contract would lose 30 rupees. So I hope you understand what I mean in this video. So I'm going to try and explain put option contract here again. So similarly, I've taken another chart. Again, I've taken the same example that the spot price is 6320 and today is 16 Jan and the expiry of this month is 30th Jan. I've again drawn horizontal lines parallel to 6400, 6300 and 6200. So in this case, the 6400 premium is trading at 105, meaning buyers of this contract are expecting the markets to drop to 6295 by end of this month or on the day of expiry. And the 6300 put option is trading at a premium of 55 rupees, meaning people are expecting the markets to drop to 6245 or 55 points below 6300. Similarly, 6200 contract is trading at a premium of 30 rupees, meaning the buyers of this contract are expecting the markets to drop down below 6200 by 30 points, that is to the target of 6170. So assuming on the day of expiry we expect the markets to stay at the same place, 6320. So what will happen is the 6200 contract will become 0 because it has not gone down below 6200 at all. The 6300 contract will also become 0. So I'm gonna let me like kind of mark it here. This will become 0 assuming markets end up at 6320. This will become 0 as well, and this one will become actually 80 because market ends up at 6320 at the end of expiry. So this 105 will drop to 80 rupees because you expected a target of 6295, but market ended up at 6320. So the put option buyers will actually lose. So similarly, let me put up the values for the call option that we talked about. Assuming the markets are going to end at 6320, 64 this contract will become 0 because it's not crossing it's not going to cross 6400 because the market ends at the same place flat. And assuming the 6300 call option will end up at 20 rupees. So again the buyer loses here, and the 6150 call option will end up at 120 rupees. So actually you can see that this intrinsic value contract the buyers will lose pretty minimal, but the investment initially will be high. The lot size for Nifty is 50. So when I say if you want to buy 6200 call option, you will need to pay 50 into 150, the premium. 50 is the lot size. So I would need 7500 rupees to buy this. So on the other hand, if I were to buy the 6300 call option, the premium is 80 rupees. So 50 into 80 would be 4000 rupees I would need to pay. In case of 6400 call option, I would need to pay 50 into 35. I would need to pay 1750 rupees to buy that contract, to buy one contract. So assuming the market goes up exceedingly high, let's say it touches 7000, Nifty touches 7000 by end of this month, 6400 call option will be close to 600 rupees. 6300 call option will be 700 rupees, and 6200 call option will be at 800 rupees. So all these will go up, and all these buyers will be actually gaining. So I hope I've tried to convey as much as possible with the limited resources I have in my computer with these graphs and charts. So I hope you got what strike prices and the premium and expiry and so on. Let me also quickly make something else also here. Let me mention, let me add one more row here. How do I add a row? Insert rows below. Yeah. So to summarize in short, Finally, premium, like I said, premium is what you trade. Premium is directly proportional to the price movement, and the premium is inversely proportional to time left to expiry, meaning as the time is going closer and closer towards the expiry, the premium will tend to fall down. And in case of a call option, if the markets are moving in your favor on the upside, then the premium will tend to rise. So that's why I said directly proportional to favorable price movement. If it is on the downside, then it's going to drop. Inversely proportional on time to expiry, so that's always a negative for us. So as the time nears towards expiry, and you're always going to be on the downside actually. And the premium is directly proportional to VIX. VIX is nothing but volatility index. So if the volatility is high or is increasing, then you can expect the premiums to go up. If the volatility is coming down, or the markets are tending to stay flat, or the volatility is coming down, you can expect the premiums to drop. So these are the three factors based on which the premium will depend on, and it's also depending on the buyers and sellers in the market. So ultimately they decide the price. So like I said, if you're buying a call option and if the market is continuously going up, then your premiums will go up. And if you're buying a call option and the markets are going in the reverse direction, the price movement is going in the reverse direction, then the premiums will fall down. So the premium of a options contract is directly proportional to the price movement of Nifty, and it is inversely proportional to the time left to expiry, meaning like I said in the video, there are 12 more days. So as every day passes and passes, the premium will slowly trickle down and fall down, and it will tend to go towards the intrinsic value left in the contract. And the third point is it's directly proportional to VIX. If the VIX, or if the volatility of the market is rising, then you can expect the premiums to go up a little. And on the other hand, if the volatility is decreasing, then it will tend to fall down. So that's it for now. I'm an authorized person for Zerodha, and I offer free training for Zerodha clients of mine. Stay in touch with us. Subscribe to our YouTube channel. Bye bye.